just business news, we're news for business people.
Good afternoon and welcome. You're watching Bloomberg Quint Live. These are the headlines. It's another strong day of trade for the benchmark indices. The Nifty trades above the record 10,400 mark. India's manufacturing PMI expands in the month of October, but only marginally, comes in at 50.3 compared with 51.2 in September. Maruti Suzuki's wholesale vehicle sales grow at 9.5% in the month of October, in line with analyst projections. Mercator Lines is looking to sell its stake in 2 Indonesian coal mine blocks for around 1,000 crore rupees. That's a Bloomberg Quint exclusive, sorry. And Hero MotoCorp, along with Tech Mahindra, are the 2 nifty earnings that will be reported later today. And up next, you don't want to miss this, it's Hot Money with Darshan Mehta.
Thank you, Alex. Hello and welcome to Hot Money on Bloomberg Quint Live, India's first digital live streaming business news service. This is the show which gets you a complete wrap of all the stocks that are buzzing in trade. I'm Darshan Mehta. Joining us on the show today is Savi Jain of 2.2 Capital, and he believes that the markets are expensive across the board. Ashwin Agarwal of Newberry PMS believes that the markets are trading above its fair value. And Samir Kalra of Target Investing says that trade the dips and invest the fall in the market currently. Today on Hot Money, we will discuss stocks like DLF, GMR, Bajaj Finserv, Capital First, as well as Escorts. So these are the 5 stocks that we'll discuss. Let's start with the first stock, and that is DLF. The counter was up almost 8% in trade yesterday. It's up another 3.5–4% in trade today. So real estate seems to be on a run. Post demonetization, everyone thought that the sector is going to go through a bad phase, but surprisingly, real estate turned out to be one of the best performing sectors across the board. What should one do with the leader or the largest company in the real estate sector, DLF? Let's ask our guest. Savi, do you think that this trend will continue? Does it warrant the high price rise that has happened, or it's just blind money chasing? Or what do you make of the move in real estate and DLF?
So we are pretty negative on the real estate sector in general, given that especially in the light of RERA and GST. So especially in the premium end of the segment, we are pretty negative, because there's some action happening in the affordable housing segment. DLF is present more in the premium segment. So we are bearish on the stock. If you look at the main drivers of DLF, majority of its value comes from its land holdings. Now that's a pretty illiquid holding, and it's very difficult to assign a value to that. Best guess is that given the current sentiment, you're not going to get much value out of that. Anyway, I don't think they'll be liquidating that in the near future. Now, if you look at the other 2 parts of the business, there's the commercial business, which is the Cyber City Hub, where GIC invested. That is obviously a good part of the business, but I don't think it contributes more than 25% of the value of the stock. And then there is the residential business. 95% of that is in places like Gurgaon and tier 2 cities, etc. Okay. So there's a lot of inventory overhang there, and also most of the DLF's inventory is in the premium segment. So all in all, it's a business that's going to generate not more than single-digit ROE in the next many years. And to pay a 1.5 time price to book for a business which generates less than FD returns, I think that's being a little too wishful.
So what do you explain the price rise that is coming in? So
I think a lot of it is to do with the exuberance in general in the market. If you look at, there are some much better, real estate stocks like say a Sobha or a Godrej, which generates at least 15% ROE. Obviously, they're trading much more expensive than what a DLF is, but unless we see specific triggers to the performance of the business, and instead of valuing it on a net asset value, where you say ki, I have land holdings, book value of which is such and such, and therefore the value of the Now who knows, 20, 30 years they do not monetize the land. So if you're looking at a business from a going concern basis, I don't think it's fair to value it on a NAV basis.
Samir, fair points what Savi had said, or you have some other?
I have a contradictory view on DLF. I'm bullish on it because of two reasons. See, if you see demonetization, RERA, now they're planning of GST coming into the real estate sector. These are all negatives for the sector as whole, right? Now, when you say negative, these are mainly negative for the developers who were, small developers, who were doing more on cash basis, and the money was flowing from one project to another project. Now, the whole point is once all this is done in the next few quarters, and the results even may get hurt in a couple of more quarters. The point is, North is a very unorganized market in a certain sense. So, for Gurgaon and for DLF, it's a bigger opportunity. So there'll be a lot of consolidation on the north side. If you see the west of India and south of India, they're more organized in a certain sense of play. And north has always been the, the unorganized, the
smaller players.
Smaller players and more of fisking, which hurts the GST even harder. So there I see a lot of consolidation. So I see DLF coming into the city center. So they already have a project going on in Delhi, which is a commercial side of it, which will give them the edge or in the commercial part of it. They've divested in the cyber hub, that's 40%. They might do a divestment even further if required to service that debt. But right now I think that 10,000, 11,000 which they get out of the whole system will be helpful on the whole basis. I don't think so they right now need to take a land monetization view right now.
Okay.
So I think there's a disconcern there. He's talking about divestment. Now that's promoters selling their stake, and that's money that promoters are getting, which they are infusing in the company and on a preferential basis. So all shareholders will be diluted. So there's a cost of that infusion. It's not free money that is coming. They're again talking about a QIP after that. So there'll be major dilution given the current market prices.
See, it's more of from a point of view, either you keep the debt at the same levels on the consolidated basis right now and not capture the next leg up. Because when the consolidation happens and if you take a further debt on what levels you have, the market will not be happy, the investors will not be happy. So they rather give you that space of diluting right now and reducing that debt part on the consolidated basis and have a space of increasing the debt when you get good assets for acquisition. That's what I think the company is prepping for. Because now, again, I'm saying north side is very, very unorganized in a certain sense.
Okay, so a positive and a negative view. Ashwin, which side are you on?
So I'm neutral. Let me just lay out the facts. Basically, they have 3 crore square feet of commercial property that's on rent, generates them 3,000 crores. If you do a rough valuation, comes to around like $100 square feet they're charging. Usually rental yields are around 10% of property value. So that comes to around 30,000 crore, around what their debt is. So the other part is, now they say in the presentation they have 20 crore land bank, like developable area land bank. And the total EV of the company is 60, like 30 debt and 30 is the market value. So basically, if you say they have potentially development of 2 lakh crore revenue, but that'll come over probably 20 years, so that doesn't mean anything if you discount it back. I think they have a huge operating leverage if property prices improve. So say if you have 20 crore square feet land and property prices go up 20%, your cost of construction doesn't go up, right? So there's a huge delta on your cash flow. So I would say I would want to buy DLF if I had an opinion that property prices are going to rise, which obviously I don't at the moment, but maybe like when it starts rising, I think...
So you'll take a call on DLF once it... Right now you're neutral.
Right now I'm neutral. I'm hoping that it declines to make it as cheap as possible, but the real delta on the stock is the land bank. That whatever the market might value it higher if property prices start moving, and also they'll have to execute. So I mean, I'm saying I'm neutral, but yeah, like if it goes down significantly and if you think property prices will go up, which they will eventually, but you have to try and time it. So
okay. So that's the view that's coming in on DLF. We've got actually 3 different views that are coming in on DLF. Savi is bearish on the entire real estate space currently. We have Samir, who is indicating the fact that he is rather bullish on it, and Ashwin right now has a neutral view. Let's move on to the next stock, and that is GMR. The counter was up 10% in trade yesterday, up another 1% today. So does it make sense for an investor to invest in such high debt companies? Do they warrant a turnaround? Are assets that they have worth the price? I'll start with you, Samir. GMR, does it make sense for investor price wise or investing in such a company?
See, it doesn't make for a guy who wants to invest on a hope. So what the story where every infrastructure company is playing on is the reduction of debt. Now the only point is, for GMR, I'm a little positive, so I'm neutral on that basis, is because of the the subsidiary of the Delhi airport which they have. So in that, the retail income in the future is going to be very big. So they have a Aerocity, which is similar to a cyber hub. So that's around 2.6 lakh square meter kind of a land. So that will generate a higher rental income for them. Second is, they've just recently given Bharti Realty the project to retail development. That's another 1.6 lakh square meter. So that kind of amount of rental income which they'll get out of these both projects will help the cash flows. So if the cash flow generation betters up in the future, then there'll be a turnaround in the firm. And already the interest and the depreciation expenses have reduced from last 2 quarters. So there is a kind of a transformation taking place, but I would wait for any investor to get in right now. Okay, so that's the wait approach that Samir is saying. Ashwin, any view on GMR?
So I mean, I don't track the company really deeply, but whatever I know is it has debt around 20,000 crore, equity value 10,000 crore. It's into airports, roads and power. Roads and power are loss-making and airports are profit-making. So if the lenders make them divest the crown jewel, like the airport subsidiary, that's negative for the GMR shareholders, and then I wouldn't even want to touch it. While if they can somehow save their airport assets and divest the roads and the power business to pay off the debt, that would be positive for GMR. But still, it's a very risky bet to make because it depends on future outcomes. So, I mean, I wouldn't want to invest more than like a couple of percentage points on my portfolio.
I'll just have to take a detour. Godrej consumer numbers are out. Profit at 362 crores. Our estimate was 351 crores. Profit doesn't matter. Let's take a look at the sales and the EBITDA once we get it. So, we're just highlighting the numbers that have come out. I don't have the revenue numbers that with me. The counter seems to be doing well. It's up almost 4%. So that's the number we have. We'll come back to the numbers once we have more clarity. Savi, GMR?
Yeah, so again, we are very negative on the infrastructure sector. You have to take a leap of faith. If you see 10-15 years of operating history of all infra companies, none of them have generated more than 15% ROE on a sustainable basis. And if you can't do that, then your stock will also not do better than 15-20% unless you're getting it at very, very cheap as compared to the book value. So, so you need to take a leap of faith. Now, given the kind of debt that is there on the books, you have to really assume that there's going to be a huge haircut for the lenders, for the equity holders to make any significant money from current levels. Their subsidiaries, I think I would not value them at anything because their road and their power business, both of them are making losses. Some of the assets are in SDR, some of them are still not operational because of lack of fuel linkages, etc. Now, if you look at the airport business, that's the crown jewel. There again, if you followed, the regulator has recently in the Delhi airport cut the tariffs by 60-70% because they were overcharging the customer in the 2014 to 19 cycle.
Yes.
So that in the next 2 years is going to impact them heavily on the cash flow side. So there is a lot of regulatory uncertainty even in these good assets that you have. The regulator wants you to not make more than 16% IRR, whereas GMR is talking about upwards of 20%. So that risk always remains even in their core business. So having said all of this, you have to really take a leap of faith to invest in a company like
Okay, so that's the view that's coming in on GMR at this point of time. Just want to reiterate, Godrej Consumer, the top line is 2,500 crores. It seems to be an inline set of numbers. We were anticipating close to 20 crores, so pretty much in line. I don't have the EBITDA numbers with me. Other income higher, so it seems to be an inline set of numbers. The counter is reacting positively. Let's move on to the next stock, and the counter that has been moving significantly, Bajaj Finserv. It's a holding company of Bajaj Finance. Bajaj Finance seems to be doing well. Should one take a view on Bajaj Finserv? It's up almost 1.2%. A lot of M&A buzz deals that are happening on the stock that Allianz wants to exit. Ashwin, I'll start with you. Do you have a view on Bajaj Finserv?
Yeah, so I'm neutral. Basically, Bajaj Finserv is a holding company. They have 55% in Bajaj Finance and 74% each in the life and the general insurance. So basically the holding company discount in India is usually 40 to 50%. But if you actually look at it, it shouldn't be more than 30%, because assuming the only way a holding company gets cash from the subsidiaries through a dividend, there will be a 20% DDT and then a 10% income tax. So basically, you should try and take a 30% discount. Now, based on that, or the other cases, if they go out for an IPO, then there's no discount, So at max, it should be a 30% discount, but Bajaj Finance is valued at 55,000, like 1 lakh crore. So their 55% stake comes to 55,000 crore. Their general insurance is actually the highest, the most profitable in the private sector. So if you assume, and the numbers are kind of similar to ICICI Lombard, so if you value that at the same thing, which is 30,000 crores, and the life insurance, I just put a EV of 20,000 crores. The thing with me is, I think all of their subsidiaries are overvalued, but based on just the market value, it seems fairly priced. But I would say Bajaj Finance and the insurance companies all are a little overvalued. Okay. So I'm neutral on valuations, but I think all three businesses are great.
Any view on Bajaj Finserv? You seem to be negative.
Yeah, so if you need to take a call on Bajaj Finserv, you are essentially taking a call on Bajaj Finance, because 70% of the value lies there. And then there is the general insurance business, which is again very profitable and the market leader. Very negative on the life business, because they don't have a banking parentage, and unless you have a strong bancassurance partner in life insurance, you cannot do anything. Yes. So I think there will be consolidation in the industry, and life business is not much value. So if you value Bajaj Allianz at 4 times price to book, which is what ICICI Lombard is trading at, and you value Bajaj Finance on current market value, which we believe is very expensive. On top of that, you need to apply a holding company discount. I don't agree with the 30% number that Ashwin said, because for Bajaj Finance, Bajaj Finserv holds 55% in the company. So there is no question of those leakages that he talked about in terms of income tax and dividend, because it is essentially the numbers are consolidated in the parent company. So overall, Bajaj Finance itself is very expensive, 7 times price to book for an NBFC business which makes 20-21% ROE. For you to pay that kind of a multiple, it defies any valuation logic. So therefore, we are negative. We like the businesses, but we don't. So like the
in short, you'll mean you negative on Bajaj Finance also.
But on the stock prices, yes. Okay. Not on the business. Of course, is doing well.
Okay, Samir.
So I'm neutral on Bajaj Finserv because see, anyone who wants to give it value just because it holds a certain percentage in Bajaj Finance can right now directly invest in Bajaj Finance, right? If he's an investor, why to have a 55% and why not to have 100% if the business and everything is great enough? On the insurance part of business, the only trigger which I see is earlier there was no insurance company showing that kind of a growth and being listed. So you had a premium of that as well. Now as more of insurance companies keep on getting listed, that scarcity premium which Bajaj Finserv was taking into will kind of go out of market. That's what has happened in other firms as well, where different companies have been listed. Once the guy who was the only guy listed in that firm happens. Now on the insurance business, once they take a call whether the alliance exits the business or not, because German newspapers quote alliance saying that will stay, Indian newspapers say they'll get out. So where eventually it happens and how it happens, I think it's more about the time. I would be more interested in how they make the listing of the insurance business.
Okay. So that's the view that's coming in on Bajaj Finserv. Savi is a little negative on the counter at this point of time. Sameer does indicate the fact that it's better to invest directly in Bajaj Finance, and Ashwin here is rather neutral on the counter. Before we move on, here's a quick recap of all the guest view that on the stocks that we've covered till now. Okay, the next stock on our list is Capital First. Came out with numbers yesterday. Strong set of numbers. What should one do with the counter going ahead? Savi, I'll start with you. Any view on Capital First?
Yeah, so we are slightly positive to neutral on the stock. Capital First is like a poor man's Bajaj Finance. Yes. It's in the same segments and it has the same aspirations, but it's trading at half the value of.
But can it be a Bajaj Finance?
Yeah, so that's a very good question because Capital First is at 12-13% ROE. Now that's a trajectory that has improved from close to 8-9% since Vaidyanathan took over a few years back. And he's done a phenomenal turnaround in terms of making it from a wholesale lending business to a retail lending business. Now the characteristics are slightly similar to what a Bajaj Finance is, in terms of being present in consumer lending space. It's trading at half the value because the ROEs are lower. ROEs are lower because yields of Capital First is lower than what Bajaj Finance is. Cost of funds is higher. NIMs are therefore lower. Also, the credit costs are higher. So overall, if Vaidyanathan, he was there on Bloomberg as well. He's talking about reaching 20% ROE over the next 2 years. If he does that, then I think there is a case for significant re-rating. Given that it's trading at 3 times price to book, I think there is some value left given the growth that he's projecting of 25-35%. So overall, I would rather play a Capital First as against playing a Bajaj Finance, which is already fully valued.
Okay, what about you, Sameer? You don't track the counter. I'll very quickly. We're running out of time.
It's similar to Bajaj Finance, but just all the NBFCs are expensive. In a lot of ways, it's like home equity loans, like loan against property. So it's like a businessman mortgages his property and takes loans against it. I mean, these things kind of systematically blow up like when there's a huge credit crisis. So, I mean, right now the NPAs are around 1.5%, but I would say if we take in the full cycle, considering the tax on the average man is increasing and taxes on businesses are increasing, I'm like neutral to negative, but purely based on valuations, it seems like a good company. But it's still untested in underwriting throughout the full
Okay,
cycle.
so that's the view that's coming in on Capital First. Savi is rather bullish on the counter because he believes that if the management is able to get the ROEs up to 20%, that is something that it can come close to what Bajaj Finance is doing. Sameer does not track the counter, and Ashwin is rather neutral on this one. And the final stock is Escorts. Came out with strong set of numbers yesterday, but the counter is down because the management commentary was not the confident. They believe of a potential slowdown that can come into the final quarter. Ashwin, very fast. Escorts, do you have a view?
It's a tractor manufacturing company. Tractor margins are usually higher than the auto ones because there are fewer players, but I mean, it's very richly valued considering Mahindra is a formidable competitor. So for them to gain market share over the years is not going to be easy. So I'm bearish based on the valuations.
Do you think the valuations are not fair at this point?
I think the valuations are a little too high.
Okay, Savi, you don't track, or do you track?
No, we don't track this company, so
okay.
I don't have a view.
Okay, Sameer, do you have a view on Escorts?
I'm bullish on it, given a separate valuation. I'm just talking about the business. So they have a plan of going from 80,000 capacity to 115 next couple of years. So that is on track for them. The management showed a little slowdown in next few quarters because, see, any which way when the season is out, there'll always be a slowdown in the system. Now, the only other part which I think is the positive in the results was the construction equipment business, which they have. So volume growth wise, it was good, and this was the first quarter they showed the EBIT positive. So that kind of, if continues in next few quarters, there'll be a different valuation which is given.
But that is a low margin business for them.
That is a low margin
which overall impact their margins, the construction equipment margin, even though they showed us, I think, a 30%.
But on the absolute basis, if you see, if it adds a value. Right now, it was dragging for last few quarters. It was dragging
I
that
think
value.
the construction equipment only contributes like 10%, so it's
16%.
16%.
So
Okay, so we're running out of time, but that's the view that's coming in on Escorts at this point of time. Ashwin is negative in it, Savi does not track it. Samir is bullish on the counter. Before we wrap up on the show, here's a quick recap of all the guest view on the stocks that we've covered till now. Okay, Ashwin, Savi, Samir, thank you so much for joining us on the show. With that, it's a wrap on today's Hot Money. Thanks for watching Bloomberg Quint.